Hello, happy Friday to all of you DGI enthusiasts out there. It is Colby, the DGI Crab. Took last Friday off for the first time in the channel's history. Back this Friday to go over, that's right, the 4 tiers. The channel covers 60 dividend growth stocks split into 4 separate categories or tiers that are based off of your age and time horizon, which I believe is the most important metric for a dividend growth stock investor to keep in mind. They're just going to tell all of you right now, this is going to be the last time that I do this video on a Friday. But hey, that's all right. I'm still going to do these videos, but I'm going to move the schedule now and do these on Sunday instead of on Friday. Typically, I have my secondary passion, Kansas City Chiefs, take up a lot of my time on Sundays. That is about to come to an end after Super Bowl Sunday. And I also thought it would just make a little bit more sense to do this particular video at some point on the weekend as opposed to right at the very end of market close on Friday. Sunday is a good time to just kind of relax, get your bearings, and maybe spend a little time coming up with a plan for what you're going to be keeping a lookout for as far as good value bargain buys in the stock market. So that's what we're going to go over here today, like we always do. And I will remind everyone, I am not a licensed professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. For anyone out there who is new, the DGI Crab allocation strategy is as follows. I do 50% of all new investment money into age-appropriate ETFs, which gives me automatic diversification, so I don't have to worry about any portfolio weighting when it comes to individual single stocks. For the single stocks, I'm looking for ones that are yielding 30% or more above their 4-year average yield. We've got a collection of stocks here with a very long and consistent track record of increasing their dividends year over year. So when I'm acquiring that passive income, I want to make sure I'm getting it at the best price I possibly can. Because let's face it, individual stocks are more inherently risky than ETFs. So we got to do some bargain shopping there when we're doing the individual stock purchases. Now, I have a top 10 favorite stock list. It's just my own personal favorite. Those particular stocks I will invest in if they are yielding just 20% or more above their 4-year average yield, because I like them that much. And it's fairly rare that they spend a lot of time yielding even that high. Now, I will remain within my personal tier unless there's a stock in a different tier yielding 50% or more above the 4-year average yield. At that point, it just looks like it's a fire sale, and it might be a good idea to take advantage of that particular deal. Finally, if there don't happen to be any viable stocks within my tier in a given week, I'll just add all of my investment capital for the week into ETFs. Not trying to time the market with the ETFs whatsoever. I am trying to time the market with those individual single stocks. So, all right, everybody, let's hop on into the spreadsheet here. We have the tier 1 stocks here for the 18 to 30-year-old investor. This category of stocks is designed to get a starting yield that's on the lower end. You're going to yield between 1.5% on a lot of these, but we're trying to get a cumulative dividend growth rate well above 10%. This is the age category that's got plenty of time in the market to allow those aggressive dividend raises to really start snowballing over time. The math just works. This is what's going to give you the most dividend income over the long haul. And when you're at the point where you're living off of that sweet passive income and you're not reinvesting dividends anymore, you're going to get double-digit raises every single year off of these guys. How good of a deal is that? So, got 2 stocks here still in the buy zone. It's been the same 2 here for a little while. Nike, which continues to just look notoriously cheap and undervalued here in the 70s. The 4-year average yield gradually does climb up the longer Nike stays down here in the dumps. Now, if it stays down here in the 70s for most of 2025, eventually at that point, this might not look like as appealing of a deal. But I personally do still believe that Nike has a turnaround story. They're sailing through some troubled waters right now, but we're talking about an internationally recognized brand. I think they're going to be able to right the ship eventually. And then Nordson, a dividend king with a 50+ year track record of increasing dividends. They typically do pretty aggressive dividend increases. Last year was 9.77%, which is actually on the low end for Nordson. They usually are doing dividend increases in the teens, and I'm very happy with a starting yield at 1.42% with Nordson. And just so you guys know, any of these stocks down here in the red, I don't sell this stuff. I'm a buy and hold investor. I keep my dividend reinvestment turned on across the board. And these are just stocks that I'm not going to aggressively add new money to while they appear to be trading pretty expensive. But I'm not a trader, so I'm not going to be buying and selling positions, selling out of Broadcom to move that into Nike or whatever. I'm just going to let the runners run as far as that goes and build up the ones that are down in the dumps in the meantime with the new capital. Tier 2, age 31 to 41-year-old investors. I'm going to be in this category myself for another 9 or 10 months. So that means that I'm personally putting a lot of emphasis on Hershey. I continue to get on my soapbox about what a great deal I think Hershey is. The stock price keeps going down. I actually saw my guy Bert over at the Dividend Diplomats initiated a position in Hershey last week, I believe. I was really excited to see that. Way to go, Bert, if you happen to be watching this one. I'm definitely just steadily adding more to this one. Target has been in and out of the buy zone over the last couple of months. It looks like a good deal, especially under $140 a share. And American States Water, guys, this is a sleeper. If you're a dividend investor, you probably have heard of American States Water, but if you haven't, listen, this is the smallest market cap company that I have in all of the 60 stocks on the channel, but it has the longest annual consecutive streak of increasing those dividends. It is remarkably consistent. It just seems like water utilities are all trading pretty low right now. I think this is a great opportunity to pick up American States Water and just hold it for the long haul. Tier 3, age 42 to 43-year-old investors. Now, this group is starting to get a little bit higher starting yield, a little bit slower growth rate, but certainly not a negligible growth rate at all. But when you start getting up to 42, 43, 44, and you're adding more money into that portfolio, you're really trying to, juice that yield just a little bit more so you can get yourself over the edge to financial freedom. Any of you that can do that before the age of 50 years old, you're way ahead of most folks. I can tell you that. So we got a nice group here of 4 stocks that are in that buy zone, with Archer Daniels Midland being very undervalued still. It's been a very hard year for Archer Daniels Midland. They have a scheduled dividend increase coming up. They usually do that. They usually do their scheduled dividend increase, I believe, in the first payment that they do of the year. Could be the second. Should have checked on that first, but they did an 11% increase last year. It was the best of this particular group. I'm very curious to see what they do this year since the share price is still down. This is going to be one to keep a very close eye on to see exactly what they're up to. But when it's yielding up here at near or above 4%, I just don't think you can go wrong with this one, despite the drama that they've gone through over the last year. Hormel stays down in the dumps. I'm still a believer in Hormel. We'll see how it goes. Dividend king. They've been through tough times before. They weathered the storm, so we'll see how they come out of this year-long slump that they have been on. But I still feel pretty confident about Hormel too. You can get that yielding nearly 4%. Genuine Parts Company absolutely looks like a good deal down here around 116. American Tower is a REIT, so that might be one because it is a REIT and doesn't pay qualified dividends. You might be thinking about this one more in a Roth IRA, but it is not necessarily a bad thing to have some REITs in your brokerage account as well. It's just keep in mind for tax purposes that they're not quite as a tax advantage. Those dividends from REITs aren't as most of the other stocks that this channel covers. And then Pepsi, one of my top 10 favorite stocks, it is just outside of that normal buy zone at 30%, but because it's in my top 10 favorites, like I said, if it's 20% or more, I am all in on Pepsi, and it remains in my buy zone for it specifically. Johnson & Johnson was there, at least for these last few weeks or so. It started to rebound a little bit. I'm really kind of looking for 150 or less on Johnson & Johnson, roughly. But definitely one of the steadiest stocks that you can find out there. There's been some fear in the market. I think a lot of it has to do with RFK Jr. and what he might do in the Trump administration to potentially impact negatively big pharmaceutical companies. A lot of it's speculation right now. We'll just have to wait and see. Tier 4, 54 and older investors. We're trying to get higher starting yield now. If you're not at financial freedom just yet at this point, this is the kind of stuff that can juice that income when you're actively investing to really get you up to that point where you can retire. I've been waiting throughout the history of this channel to get something at that 30% or more undervalued. Still haven't found it just yet. Realty Income flirts with it every now and again. Personally, I'm going to continue, if I'm in this age category, to double down on my ETFs as opposed to taking the risk of buying an individual single stock that may just not be trading all that cheap. I'm definitely going to keep a close eye on Realty Income. I'll definitely keep a close eye on Verizon to see if they can drop down a little bit more, but definitely pumping the brakes on aggressively adding here. Just real quick, this separate tab, not a new group of stocks. This is just a separate tab I track my top 10 on. Take a look at it if you want. Pause the video if you like. Nothing new to go over here. These are all located somewhere in the first 3 tiers. And then the allocation strategy. So, for me personally, this is kind of how I look at it. Half the money goes into age-appropriate ETFs. For me, that tier 1 group, we're talking S&P 500, small caps, a little bit of dividend appreciation, and international. BYMI, the only non-US holding that I have. Absolutely my favorite non-US stock ETF. BYMI, really cool. Check it out. Got a video on the ETF playlist where I go in depth on BYMI. I think this is one that really gives me the coverage that I want to the non-US stocks and not have to worry about those international markets. Just a nice one to have there. Now in tier 2, I actually do those same 4 ETFs. I just do the weighting a little bit different, where I do the dividend appreciation as the main emphasis. A little less into the S&P 500 and small caps, but I'm still doing that. And then tier 3, my 3 favorite higher yielding dividend growth ETFs, SCHD, VYM, DHS. This is probably how I'd be allocating that if I were in tier 3 right now. Like I said, still got another 9 or 10 months to go on that. But come November, this is what I'm going to be doing with the DGI Crab Channel portfolio for those ETF allocations. Tier 4, this is the collection that I go with here, where I've got my high yield stock ETF with SPYD. And then I get some exposure to high yield bonds, preferred shares, MLPs, covered call ETFs. I think these 3 are the cream of the crop. Devo, JEPQ, and SPY. And then BYMI, of course. And I'm doubling down on all of these if I'm in tier 4, because there's not anything in my category that looks like it is cheap. But this is probably what I'm looking at for tier 1. I'm going to definitely grab Nike and Nordson. I'm going to take advantage of Pepsi being on sale. And because Hershey and ADM are 50% or more undervalued, I'll nibble on those a little bit. Tier 2, grabbing Hershey, Target, and AWR in my own tier. Nike and ADM and Pepsi, kind of same idea there. And then in tier 3, ADM, Hormel, GPC, AMT, Pepsi, with a little nibble into Nike and Hershey if I want. And I don't double down into VYMI if I'm doing an ETF double down, so for that extra 5% left over. I think my choice this week for those 54 and older investors, I'd go with Pepsi if I had to pick just one. It's top 10 favorite, yielding in the high 3s. That's good enough when you're getting some of this other high yield stuff. So all right, you guys, that is the video. a week from this Sunday. Super Bowl Sunday will be the next time I do this one. Hope to see you there.